Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending November 12th, 2021. I'm Preston Brent. Thanks for tuning in. This week's theme is how high can we go? Well, until the money runs out, essentially. Let's take a look at this past week and see where everything is sitting right now. So we look at the sound bites on the index performance. You can see, surprisingly, even with a strong finish on Friday, the markets finished the week in the red, but just barely. The Russell was leading the way to the downside, but year to date, everybody's still very, very healthy. You can see the PE ratio. The forward 12-month PE ratio has come in just a little bit, but it's at 22.41. Dividend yield at 1.28 for the S&P 10-year Treasury, a little bit higher at 1.582%. So the Treasury 10-year is about 30 bips higher than the dividend yield. So that continues to channel money in the S&P. Now the earnings yield for the S&P using current estimated 2021 earnings per share of 205 divided by the current price at close gives us an earnings yield right now of about 4.37% for the S&P. Again, the S&P yield over the 10-year Treasury is 2.79%, so it continues to channel money into the U.S. Equity markets. And you can see the VIX actually came in just barely during the week. The prior week it closed at 16.48, this week 16.29. Now, you can see the best performers for the week. Materials came in very strong, XLB, primarily because of the infrastructure bill that finally got through Congress, got signed, or is probably going to be signed. So that'll help out infrastructure companies. The worst for the week was discretionary. Spelled it wrong, but anyway, discretionary had a really not too bad, but it came in about 0.72 for the week to the downside. Annual sector performance, energy still bringing up the upside at 56.91% year to date. Utilities bringing up the rear, but still in the green at 8.74%. Okay. Now, if we look at this week, American wealth really since the beginning of this year has increased about 9.7 trillion with the move in the markets. It's about 23%. Okay. This past Tuesday, we saw our first decline in the S&P. We had a winning streak of 9 straight sessions, 9 straight trading days in a row, going back to 2017. Okay. So if we kind of take a look at this, and let's just look at some of the economic data for the week. We saw indexes falling Wednesday. We had a surprise report in the CPI. Now, we all know inflation is high, but it came in higher than people thought. So the year-over-year increase in CPI, consumer price index, came in at 6.2%. That's the highest since we've seen since December of 1990. Okay. And of course, you're seeing the normal blame of this with supply chains and high consumer demand, especially around the Christmas season. So we can expect that weekly jobless claims came in at a pandemic era low of 267,000, right? But there's still 10.4 million job openings out there. I think a lot of people are just walking away from the job market right now. And the University of Michigan consumer sentiment fell to its lowest level in a decade, probably due to inflation worries, rising prices for homes, cars, durable goods, all of that. We've got more reports of that in this survey in more than almost 50 years. So we're seeing some huge surges here across all of these boundaries. All right. Now, if we look at the U.S. Treasury market, you can see we had that upside inflation surprise. So it did force Treasury yields a little bit higher. The benchmark 10-year, as I said, ended the week right around 1.58%. Okay. A lot more volatility in the bond market than expected. It's just really a lot higher in the bond market versus the equity market. And keep in mind that even though the Feds are starting their quantitative tightening where they're cutting by 15 billion a month how much treasury they buy, by the time they get that 120 billion off the table, still going to add another 400 billion to the already bloated US balance sheet, which is sitting right now at about 8.5 trillion. So that is causing some agita in the markets. And what really moved the market, I think we had a big down day on Wednesday, but it really wasn't due to the CPI. Remember that hit at 8:30 in the morning. And the markets didn't really move that much. But when we got that bond auction that afternoon, it moved the yields up over 14 bips. That's 0.14 or 14 one hundredths of a percent. And that caused the equity markets to come down. So always remember, guys, especially now in these current markets, inflation will only matter when the bond markets say it matters. Okay. And that auction was not a very good showing, because when the Fed starts stepping away from the auction market and buying that 120 billion every month, someone else has got to pick up the slack. If they don't pick up the slack, or they may pick up the slack, but they're not going to buy it at the rates that the U.S. government buys it. They're going to demand higher interest rates, hence lower bond prices and or better bond prices. So we're going to see some shocks, I think, going into 2022. Members, with our weekly market watch this Sunday, we'll go into more detail on that, but there's going to be some great opportunities for us. Okay, so just kind of keep all that in mind. And then, of course, if we look across Europe, shares in Europe, the ECB came out, they're continuing their ultra loose monetary policy, where here we're starting the quantitative tightening. They're still saying they're going to spend like drunken sailors. But the downside of that is a lot of the European nations being more socialistic in nature and how they're run. They're considering more shutdown restrictions due to COVID coming back. I mean, guys, these people just drive me nuts. But we're seeing industrial production fell in September by 20 basis points. Now, year to date, it's up 5.2%, but it should be up a lot more than that for the year. But all the shutdowns in Europe are really going to just hurt their economy and cause them to put more money, more stimulus in that economy, which is going to make the eventual downturn even worse. The European Commission, the EC, basically is estimating the Eurozone economy is going to grow 4.3% in 2022. Okay. And then back down to a more normalized 2.4% in 2023. Okay. I laugh when I see these projections that go out beyond 6 months. They can't even get next month correct. So if you think they're going to be able to get a year or 2 years out in time correct, then I got a bridge I'd like to sell you. But that's kind of what they're projecting right now. So price action reacts to that. Okay. Inflation across Europe is expected to come in around 2.4% for 2021, above their 2% target. Okay. Then they say it's going to slow to 2.2% in next year and then down to 1.4% in 2023. But as the Zen master always says, we'll see. And I think there's going to be in for a shock. Global markets will be in for a shock, in my mind. Okay. Meanwhile, over further west to the north, UK, their economic growth slowed to only 1.3% in Q3. And that's down from the second quarter, 5.5%. So they seem to be slowing down rather than speeding up. They're going the opposite directions, but again, they're shutting things down because of COVID. These people just will never learn. Okay? But that's what's going on over in Europe. And if we take a look at, the shares and the indexes, surprisingly, they were slightly in the green. Every one of them, the Euro stocks, the FTSE, CAC 40, DAX, just slightly in the green, whereas ours was slightly in the red. Year to date, they're doing very well also. Okay. And of course, if we go over and take a look at Japan and look at the Asian markets, over there, Kishida, as I said last Sunday, he was reappointed Japanese prime minister. So that's going to help their markets a little bit. Their producer price index surged 8% year over year in October, making it the fastest gain in 40 years. Remember, that's good because that means the U.S. and Europe is buying their stuff. But with a dovish politician and they're committed to coming out in the next week or two with what his plans are stimulus-wise, well, they've been in a funk for about 2 decades now, Japan. So, but that's kind of what's going on in Japan. And then, of course, we got China. China, as you can see, for the week had a fairly good week. China was up 1.36% year to date, basically flat all year. Normally, China does really well, but President Xi really screwed the pooch there by going after the tech companies and all the others. Hang Seng was up. Year to date, they're down about 7% for the year. Property is a key pillar to the Chinese economy. And the reason why they're getting crushed is because they got so much debt, a lot of these developers. But the markets were up this past week when there's speculation. That's just speculation. They haven't done anything yet. That Beijing would announce some easing measures to help indebted property companies. I don't think they're going to do that. What they're doing is they're very smart. They're slowly slicing and dicing these large property developers, forcing them to sell off their assets to state-run enterprises for like 50 cents on the dollar. But they want to keep the consumer, the Chinese consumer, whole. So who's taking it in the shorts right now is foreign money. So when they cut the debt, and China can do this, they don't have laws like they do here in the U.S. Well, even the laws here in the U.S. didn't work very well, also because Obama screwed the bondholders with the auto industry big time in '08 and '09. Screwed them a lot. But over in China, they're doing kind of the same thing, but they're screwing foreign investors more so than everything else. Now, their PPI, their producer price index, accelerated to a greater than forecast 13.5% in October. It's a 26-year high. So that is inflation at the wholesale level. We're going to see inflation just jump up everywhere over here in the US and Europe and the Asian markets. And eventually it's going to take over the markets next year. And we're already hearing talk. The market Fed funds rate is forecasting one, possibly two rate hikes next year. And if inflation gets out of control, it's going to be three. Keep in mind that none of that's priced into the markets right now. So we've setting ourselves up to have a very choppy year next year. Now, if we look at the markets, let me just switch over and show you the indexes here. Let me just take you over to the S&P 500 E-mini futures. I've got the chart marked up. It's a daily chart. When it comes up on the screen here, you're going to be able to see, give it a second or two. So you can see we moved up to a 47.1175 high. My original forecast before having a dip was about 46.20, and we just blew right through it. We spent about 3 days there. We moved up a little bit more. We hit a fib extension node, and that's kind of where we found some of our resistance. And then we pull back. I forecasted a 2 to a 4% pullback before we make another run. We only had about a 1.8% pullback right here over the past week or so. And then we got that big green candle on Friday. I think we're going to be stuck in this range just a little bit. Remember, once earnings comes to a final end, which it should this week, it'll wrap up about 95, 98% of the S&P companies have already reported. All that's going to be left is whatever sippy cup Brandon does in his administration, or what we see with the Feds. Right? There's not a lot of other news out there, and some of it can be bad with inflation. So I will tell you, there's a lot of money flowing into the markets. Right? Members, for tomorrow evening, I'll show you some of the charts I have on money flow, and you can see where money is coming and where it's going. So I remain bullish through the end of this year, going into early next year, at least for the seasonality aspect of the market. But we'll see where we go from there. You can see these little bubbles here with a mid is kind of a projected pullback area. But if we get more money coming in, it's going to be very hard to get a pullback. I called it 2 to a 4%. We only got a 1.8% pullback. Okay. Now, if we come over and look at Nasdaq had a nice finish on Friday, still in the red for the year, but we did pull back to the original resistance point that I had on Nasdaq. And then, of course, if we look at the Dow, same thing. We came right up, pulled right back to my resistance zone in the Dow, same as Nasdaq. The E-minis overshot. That tells me we'll probably be a little bit soft next week in the E-mini S&P 500 futures. But you can see here in the Dow, we're kind of, I don't expect much more downside here, although we could drift a bit, okay? And if we have some more bad bond auctions, Treasury auctions, that will set the markets off, okay? And then finally, if we look at the Russell, we had that big breakout in the Russell. I got our members, the members that followed my path in the Russell made some serious money, because you can see here is the resistance zone. We had a prior high back in March, And when we finally broke out of these prior pivots here and then challenged March and then broke out, that was definitely a buy signal. We will come back and test that high more than likely. But, being in small cap makes sense to me going into the end of this year for a number of reasons. Seasonality, the Russell tends to be the strongest November, December, and January. And if you're going to be in the Russell, be in the small cap side of it, which tends to move even more. Right. And members, I gave you a couple of ETFs, our primary ETF to play on that. Now, you can see here, if we look at the FANG index, you can see the FANG index also was showing some strength, right? In this index, I have a composite of Microsoft, Facebook, Apple, Netflix, Google, and Amazon, or we can call Facebook Meta, whatever a knucklehead wants to call it. But that's kind of where we're sitting right now on all of the major indexes. If we look at the emerging markets, you can see it looks entirely different, right? A series of lower highs and lower lows, completely different looking chart, right? And if we look at China, you can see here what China on this particular index is tracking ETF of China. We're still in the red for the year with China, right? We're not in the green. So that is not good. This blue was the opening or the closing price of last year. And China is not looking good. And then, of course, if we look at the Vanguard All World Index, everything, the way they track it, it's still not looking that good. The market action right now is in the US. Okay, now that will switch, but right now the market action is the United States. Okay? And if we look at the VIX, you can see here with the VIX, we closed down on Friday. We're still in the middle of the yellow zone. Every time we get down towards the bottom, which is down around 14, we gap up and we move up. We've got a trading strategy that's got about a 85 to 90% success track record on it, on how we trade volatility. We're in one now. We got nice profits on volatility, and we will play that to the end, and then we'll set up for another one. It generally averages, thus far this year, it's worked 9 out of 9 times. This was the 9th trade in volatility that we take. I don't do it like other market participants do. It's got a higher probability the way I trade volatility. So this is where we're sitting right now with the VIX. And then, of course, if we look at the front month vol futures, you can see here, this will settle on 0 come volatility close. This is the front month VIX, or I'm sorry, the front month vol skew. And then if we look at the back month vol skew, it's even deeper in the green, okay, way down here. So there is no term structure fear in the volatility market right now. It is all set up nicely seasonality wide with low interest rates, with money flow coming into the markets. It's going to take some unexpected news to flip the switch here and move us lower. Okay. Even that poor bond auction, it did reverse price action on Wednesday. Not as much as inflation. Right now, the markets are still buying off on inflation transitory scheme. But as I like to remind our members, even dinosaurs were transitory. It just depends on your macro view or your micro view. Okay. Treasuries in the bond market. All right, bonds are going to be really interesting here. You can see it's finding trouble up in this area. I ideally would like to see it go higher so I can play it back to the downside again. I think the bond market, now remember, this is the 30-year bond, okay? And the 30-year bond is more sensitive to economic growth and inflationary numbers, whereas the 2-year Treasury note is more sensitive to Fed machinations in the market. Okay, and the 10-year is kind of splits the difference, but we could have a scenario where the short end of the yield curve, meaning the 2-year, is moving up while the back end of the yield curve is moving down. Right, and the yield curve measures the interest rates, which are opposite of the Treasury market. Members, I'll go through this in a little bit more detail Sunday evening, but we got to watch this because this is going to be our first clue when the market is starting to now pay attention to inflation as being more sticky than transitory. Right now, the market's bought off on the issue that it's kind of transitory, but we'll see. Okay. And of course, if we look at the US dollar here, and the dollar index, you can see just how high it's breached over the past week. We've made new 2021 highs. I'm more in tune with being long the euro over the dollar, but not right now. That's just too much energy to challenge. But I do believe the dollar is going to peter out, and then it is going to roll over. And when it does, the euro, the way to play it would be go long the euro dollar in the FX market, or just trade euro futures. Okay, right now it's just bounding higher. Um, there's some shenanigans going on in that market. Um, it's primarily with money flow and with all the money coming in stimulus wise. It's really hard to beat that stimulus at this present time. And if we look at metals, gold longer term is definitely going to be a winner. You can see here how it's trying to break out here. A little bit of a dip, but I think it's going to find 2,000 before it comes back down and finds the 1,600 levels down here. Okay, so that's a little bit about where I see on gold. I see silver as the better play. Silver has a higher beta, but I think it will move faster than gold and come back up and challenge this 28.35 level, and then come back up and challenge the 2021 high. Not by the end of this year, but certainly by Q1, Q2 of next year, I see that happening. Oil, well, oil is kind of going to be in a sideways pattern here. You can see this big move up here. Like I said here, I said fade this move. Right at this area here, I said the same thing. Fade the move. Now, can it move up higher? Yes. It depends on the demand issues and just how much of the economy the knucklehead politicians shut down. But I do believe that oil is going to eventually turn and go a little bit higher because we got very low inventories out there. And should they start opening everything back up sooner than people think, with COVID dying down, I think you'll see the demand of oil and energy push higher. Same thing with nat gas. Now, nat gas it's falling, right? Up in this area here, I said short it. Up in this area here, I said short it or fade the move. We broke the 50 EMA. Now, if we have a cold winter, you can see this jump back up. Even at this price here at 4.7, it's still too high. It should be back down around this level down here, around the 3. And I think eventually it's going to work its way back down. I wouldn't chase this down, but when you get these spikes, you want to look at bear call spreads or bear put spreads in the nat gas futures market. It's a great way to play it. Okay. Now we're having some runs in ag and meats and some other commodities as well. But from my perspective, members, the other thing I wanted to talk to members about, and for those of you on this free update this weekend, is copper. Copper is choppy right now. Longer term, you want to be long copper. Keep in mind that as China suffers, so does copper. I think it's going to run up, and then if China continues to suffer, copper is going to come down, but you're going to see people coming in and buying copper longer term. It is a great asset to be in longer term. Month to month, you're just going to get this chop, kind of like the Russell, right? On the Russell index. Longer term, we want to be bullish copper. All right, everybody, that's kind of where we're sitting right now. Members, I will see you this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. We got trades across the board, from equities to commodities to the bond treasury market. And we're having fun. It's going to be a nice year, but next year is going to be even better. There's going to be a lot of surprises, and we want to take advantage of it. All right, everybody, have a great weekend. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao.